When you look at the U.S. economy, it seems so, well, powerful, wealthy even.
Right. It projects that image very strongly.
But what if underneath it all, it's maybe a bit more fragile, like a house of cards? That's kind of what we're digging into today, isn't it?
Exactly. We've got some sources here that really question that surface strength. They
Yeah.
look at the dollar, debt, this whole idea of an illusion of wealth.
Okay. So our mission then for this deep dive is to pull apart these analyses, find the main points about these supposed weaknesses.
Yeah, what are the vulnerabilities they're highlighting? And, what does that mean for how we should maybe think about the economy?
Because the core idea that keeps popping up is, well, that decades of debt, maybe loose money policies and lots of consumption have built something that looks stable but might not be.
This illusion of wealth concept, it's quite provocative.
It really is. So where do we start peeling back the layers on this?
Well, following that house of cards idea, the foundation seems like the place. And according to these sources, that's the U.S. dollar. It's been the cornerstone for a long time.
Okay, the dollar. Makes sense. The sources mention Bretton Woods back in 1944. Maybe a quick refresher for listeners. Why was that so important?
Sure. Bretton Woods basically set up the post-war financial system. It linked major world currencies to the U.S. dollar.
And the dollar itself.
The dollar was convertible to gold at a fixed rate, $35 an ounce. So the dollar effectively became the world's reserve currency.
Right, and that gave the U.S. this, what's the term the sources use? Exorbitant privilege.
Exactly that. Because the world needed dollars for trade, for reserves, it meant the U.S. could, well, run deficits more easily than others.
Oh, how so? What kind of deficit?
Budget deficits, trade deficits. Since everyone wanted dollars, we could sort of pay for imports and spending just by issuing more dollars. There was always demand.
I see. So the global demand kind of soaked up the extra dollars. But, okay, that link to gold didn't last forever, did it? 1971 comes up.
No, it didn't. 1971, President Nixon basically ended the dollar's convertibility to gold. The Nixon shock.
A shock, right. So what did that mean, practically?
It was huge. It shifted the whole system. We went from currencies backed by something tangible, gold, to what we call fiat currency.
Fiat, meaning?
Meaning the dollar's value wasn't tied to gold anymore. It became based purely on, well, trust. Faith in the U.S. government, the U.S. economy. Essentially a promise.
A promise backed by confidence. And for a long time, that confidence, it held up pretty well.
It did. The U.S. exported dollars and, as the sources note, maybe some inflation along with them while importing goods from all over.
Right. Countries like China, Japan, Germany, they built up huge dollar reserves.
Exactly. They held those dollars. But this is where the sources say things are maybe starting to change now. That dynamic isn't quite the same.
Okay. How so? What's shifting?
We're seeing a slow, kind of gradual move away from dollar dominance in central bank reserves. The share held in dollars used to be over 70% back in the 90s.
Huh.
Now, the source says it was below 59% in 2023. So banks are diversifying. It's not a collapse, but a definite trend.
Interesting. That's quite a drop over time. And it's not just holding fewer dollars, is it? The sources mention other actions countries are taking.
Precisely. You see countries like China, for instance, increasing their gold holdings quite significantly. Gold is seen as, a hedge, independent of any single currency.
A traditional safe haven.
Yeah. And then you also have countries, even U.S. allies like India or Brazil, exploring ways to trade using their own currencies, bypassing the dollar altogether.
So setting up alternative channels, it does paint a picture of a less dollar-centric world, potentially.
That's the argument. The source talks about the dollar empire unraveling, but not necessarily in a big crash.
More like a slow fade.
Sort of, yeah. More through maybe neglect or a relative decline. The sources draw parallels with, like, the Roman denarius or the British pound sterling. They didn't vanish overnight.
They just gradually lost their top spot as the world changed around them.
Exactly. And the takeaway is that this shift, however slow, could have really big long-term consequences for the U.S. economy.
Okay, so that's the foundation, the dollar, maybe showing some cracks. What about the next level up in this house of cards? The sources talk about a hollow core, America's industrial base.
Right. This is another major theme. The decline of U.S. manufacturing capacity.
How significant has that decline been? The numbers are pretty stark, aren't they?
They really are. Manufacturing was, over 28% of U.S. GDP back in 1950?
Yeah.
By 2024, the source says it's under 11%. Think about places like Detroit, Pittsburgh. Their whole economic identity has shifted dramatically as factories closed or moved.
A huge transformation. And the sources point fingers, so to speak, at policy decisions. What drove this?
A lot of it, according to the analysis, was a focus on short-term benefits for consumers, like lower prices.
Okay.
So policies encouraged moving production overseas China, Southeast Asia, where labor was cheaper. Trade deals like NAFTA, giving China permanent normal trade relations. These are cited as accelerating that offshoring trend.
The idea being cheaper imports are good for consumers, even if it means fewer manufacturing jobs here.
That was often the justification, yes. But the consequence, as one source puts it quite bluntly, is we became addicted to stuff it doesn't make.
You see that everywhere, don't you? Big stores packed with imports, Amazon boxes arriving constantly.
It fuels a consumer economy, heavily reliant on getting goods from elsewhere, not necessarily making them here. And while, yes, the service sector grew,
It's not the same.
it's different. The sources argue that manufacturing is really crucial for generating wealth, driving innovation, creating those high-skilled jobs. A service economy alone might struggle to do that in the long run.
That makes sense. And this connects to another point, this idea of the resilient consumer we keep hearing about. Sounds good, but
Yeah, the sources question what's really behind that resilience. Is it rising wages and productivity or something else?
and the answer is
Increasingly, it seems to be debt. Household debt hitting, what, $17.5 trillion in 2025, according to the source.
wow, that's huge.
Plus, you have very high credit card interest rates, over 21% on average, and delinquency rates climbing. It suggests people are relying on credit, not necessarily income growth, to keep spending.
So the resilience is maybe built on borrowing, part of that illusion of wealth again.
It fits that narrative, yeah. A feeling of prosperity, maybe not fully backed by fundamentals.
Okay, so if we wanted to reverse this hollowing out, rebuild industry, the sources talk about an industrial rebirth. What does that entail?
Well, it's a big undertaking. It would need serious capital investment in U.S. factories and tech, regulatory changes to make it more attractive to produce here, and maybe even a cultural shift, valuing making things again, not just consuming them.
Sounds like a long-term project.
Definitely. Yeah. But the argument is it's necessary to avoid just being a, quote, consumer colony dependent on others.
Okay, so we had the dollar foundation, the weaker industrial middle. That brings us to the roof, maybe. The inflated roof of monetary policy, the Federal Reserve's role.
Right. This is the top layer in the analogy.
Yeah.
The argument is that Fed policy, especially over the last, say, 15, 20 years, has contributed to this sense of inflated prosperity,
How specifically?
primarily through keeping interest rates very low for long periods and through quantitative easing, or QE.
QE, that's when the Fed buys assets, injects money into the system.
Exactly. Buying treasury bonds, mortgage-backed securities. It massively expanded the Fed's balance sheet from under $900 billion before the 2008 crisis to over $9 trillion by 2022.
9 trillion. That's an incredible increase. Now, the sources do acknowledge these actions, especially in 2008 and during the pandemic in 2020, were seen as necessary, right, to prevent collapse.
Absolutely. They were crisis responses.
Yeah.
But the argument in these texts is about the prolonged effect of all this cheap money and liquidity.
And what are those effects?
One major consequence highlighted is this growing disconnect between Wall Street asset prices going way up and Main Street, where wage growth for many hasn't kept pace.
Yeah, you hear that a lot. And the other big one, inflation.
Definitely. The most direct impact most people feel. All that stimulus eventually had to show up somewhere, and it showed up in prices.
We all saw it. CPI hitting over 9% in 2022. And the sources argue even the official numbers might understate the real cost increase for essentials.
That's a key point they make. While the headline CPI came down, they suggest inflation for things like food, housing, energy, stuff people have to buy stayed much higher, maybe 8–10% in real terms for a while.
Which really eats into purchasing power.
Hugely. So the Fed then had to react, right? They started tightening, raising rates pretty aggressively.
Which cooled inflation somewhat, but also caused some tremors, like those regional bank issues in April 2023.
Exactly. Tightening of liquidity can expose weaknesses in the financial system. And now the Fed's in this tricky spot. Inflation's down to maybe 2.6%. They're thinking about cutting rates.
But there's another potential problem. The source mentions a tariff swan.
Yeah, the idea that new tariffs could push inflation back up, even if growth is sluggish, that raises the worry about
Stagflation.
stagflation. High inflation and stagnant growth. It's a tough scenario for policymakers. It really highlights the Fed's difficult dual mandate, trying to control prices and support employment.
Sounds like walking a tightrope. And there's one more point the source makes about the Fed's role becoming the biggest buyer of U.S. debt. What's the implication there?
It means the Fed is essentially helping to finance the government's spending by buying treasury bonds. It's sometimes called monetizing the debt.
And the concern is,
The long-term concern, according to these analyses, is that this can devalue the currency over time, keep wages stagnant for ordinary workers, and hollow out the middle class. One source even calls it monetary theft.
strong words, theft through inflation, essentially.
That's the argument, that it disproportionately hurts people on fixed incomes or those without assets that inflate in value. The core idea is that this inflation isn't just temporary, it's systemic.
Systemic because we've replaced real productivity with liquidity. Stimulus instead of savings.
That's the diagnosis in these sources, that we've relied too much on monetary tools instead of addressing underlying structural issues. And unless that changes, it continues to undermine confidence in the dollar.
So, wrapping this all up, this deep dive suggests the U.S. economy, despite appearances, might be this quite precarious house of cards.
Yeah, built on potentially shaky foundations.
We've looked at the dollar's changing global status, the decline of industry, the complexities and risks of current monetary policy.
These aren't just abstract ideas. They link back to the listener, to their savings, their job prospects, the cost of living.
Absolutely. Understanding these potential vulnerabilities seems crucial. It helps make sense of the bigger picture.
It's about being informed beyond just the daily headlines.
Right. So maybe a final thought for our listeners to chew on based on all this. If these different parts of the dollar, industry, policy are all interconnected and potentially fragile, what's maybe one unexpected consequence if there is a significant shift in global economic power, something we haven't even touched on?
That's a good one to ponder. Lots of possibilities there.
Definitely something to think about. Thanks for joining us for this deep dive. Hi, everyone, and thanks for tuning in. You're here because, like us, you're watching some really significant shifts happening in the global economy, especially concerning the U.S.
That's right.
We've gathered a bunch of sources, articles looking at government spending, trade, how money's moving around the world.
The works.
Yeah, the crucial stuff. And our mission today really is to unpack all this, cut through the noise, and figure out what these sources are really telling us about the U.S. economic future.
Absolutely. And there's some, frankly, eye-opening things in there.
Well, definitely some aha moments coming up. We're talking about the sheer scale of the national debt, how global investment is changing, and even, the return of gold as a major player.
So let's dive in. What jumps out first is the fiscal situation. It's intense.
Yeah, the numbers are pretty staggering.
Yeah.
Our sources point to a national debt now over, $34.5 trillion in 2025?
That's the figure. And the annual deficit, how much more we spend than we take in each year, is topping $2 trillion. Wow. Put that another way. It means for every $4 the government spends, about one is borrowed money.
Exactly. And the sources stress this isn't like a temporary blip due to a war or something. It seems to be structural, kind of baked into the system now, regardless of who's in charge or if the economy's booming or busting.
Right. It's persistent. I mean, think back to 2000. We actually had a surplus then. The debt compared to the whole economy, the debt to GDP ratio was under 55%.
A different world.
Totally.
Yeah.
Now, that ratio has climbed over 125%, and it's still going up.
And here's a stat that really makes you pause. The interest payments. Just paying the interest on that debt. It's now over $900 billion a year. That's more than the entire defense budget.
More than defense. Wow.
And projections show within 5 years, it could cost more than Social Security spending.
So having that much debt just hanging over us,
Yeah.
it really ties the government's hands, doesn't it? Less room to act in a crisis, less money to invest in, the future. That's the key insight. And the sources really hammer home the lack of political will to fix it. You've got big entitlement programs.
Untouchable, politically.
Pretty much. Even though they face long-term funding issues, defense spending is usually protected too.
Right. And new spending often gets approved without a clear plan for how to pay for it.
So these trillion-dollar deficits have kind of become normalized, which, as one source puts it, is a major worry.
It really is. And it leads to this uncomfortable idea our sources raise. Intergenerational theft.
Yeah, basically loading up future generations with the bill for today's spending. They'll have less to work with for their own needs, infrastructure, education, you name it.
And the rest of the world is noticing this, right? The sources talk about U.S. government credibility weakening.
Definitely. You see rating agencies downgrading U.S. debt. and foreign investors who used to reliably buy up U.S. bonds.
They're backing off a bit.
Yeah, reducing their holdings. China, for example, the sources say, cut its U.S. Treasury holdings by something like 40% over the last 10 years.
So we can't just assume they'll keep lending us money forever. That could push interest rates up even more.
Precisely. And if you look at history, the sources draw some sobering parallels. Ancient Rome debasing its currency.
Revolutionary France with its paper money.
The essence, yeah, or hyperinflation in Latin America in the 70s. These things show what can happen when fiscal discipline goes out the window.
It's not saying the U.S. is exactly like those cases. Obviously, the dollar's role is unique.
But the underlying risk is there, right? Unchecked debt can mess with your currency, destabilize things.
So what's the fix? The sources are pretty clear, even if it's tough medicine.
Spending restraint, real entitlement reform, rethinking tax policy to boost savings and production.
But the political appetite for that kind of stuff
seems pretty low right now, according to these analyses, right. And that's deeply concerning.
Okay, so that's the fiscal backdrop. Huge pressure. Maybe it's not surprising, then, that trade is also getting, let's say, contentious. Let's unpack the whole tariffs and trade situation.
Right, because the argument you hear for tariffs, this idea of economic nationalism, is often about bringing jobs back, right?
Yeah, tax imports, especially from China, encourage companies to make stuff here again, reduce our reliance on others. Sounds good on paper, maybe?
Well, the sources dig into the consequences, and it gets complicated fast. Yes, tariffs bring in some government revenue, but they also definitely mean higher costs.
For who? Consumers?
Consumers, yes, but also manufacturers here in the U.S.
Right.
Think about that example of 145% tariff on some Chinese electronics.
Ouch.
If a U.S. company uses those parts in their products, their costs go way up too. So it often ends up fueling inflation and maybe even hurting demand.
And it's not just domestic effects, is it? There's the whole retaliation thing.
Huge point in the sources. Remember 2025? The U.S. puts on tariffs. China hits back immediately on U.S. farm goods, soybeans, corn, wheat.
Right, hitting farmers in places like Iowa, Nebraska.
Directly. And it's not just agriculture. The U.S. whiskey industry, for example, is apparently worried about European counter tariffs.
So in this super connected global economy, just slapping tariffs on unilaterally, it can backfire pretty easily. Could lead to more isolation than strength.
That seems to be the warning. The sources bring up the Smoot-Hawley Tariff Act from the 1930s.
The Great Depression connection. A classic warning.
Exactly. Now, the world's different today, maybe more resilient, but the core risk of escalating trade disputes is still there. And the argument is, tariffs alone don't really work if you don't also have a plan to build up your own industries.
Meaning?
Meaning things like incentives for companies to actually move production back, reshoring, cutting red tape, training workers, upgrading infrastructure. You need the whole package. You can't protect an industry with tariffs if the industry isn't really here anymore in a big way.
That makes sense. Tariffs work best if you already make the stuff. And for decades, a lot of U.S. manufacturing moved offshore. Rebuilding that takes time, right? It's not instant.
Not at all. It's a long-term project. And another interesting angle the sources mention. Who actually benefits? Well, if U.S. firms pull back from, say, the Chinese market because of tariffs or tensions, who steps in? Often, it's European companies.
Ah, so firms from Germany, France, maybe even India. They could be the unintended winners.
It's possible.
Yeah.
The core takeaway seems to be real economic strength comes from actually producing things, not just putting up walls against import.
Okay. Production, not just protection. Got it. Now, related to all this, the fiscal pressure, the trade tensions, our sources point to another really big trend. How money is moving around the globe. Capital flows.
Yeah, this is fascinating. There's a noticeable trend of capital shifting away from the U.S. We're talking sovereign wealth funds, central banks in other countries, even big private investors.
What are they doing?
They're diversifying, putting less into traditional U.S. assets like treasury bonds and more into tangible things, emerging markets, other currencies besides the dollar. It looks like a global rebalancing of wealth.
And are there numbers to back this up?
Oh, yeah. The sources flag 2023 central banks bought a record amount of gold, over 1,000 tons.
1,000 tons, wow.
At the same time, foreign holdings of U.S. treasuries fell by over $500 billion.
So less demand for U.S. debt, more demand for gold. Who's doing this buying?
It's not just, traditional adversaries. Countries like China, Russia, yes, but also Turkey, India, even allies like Saudi Arabia are actively trying to reduce their dependence on the dollar, this whole de-dollarization idea.
Which used to sound kind of theoretical.
Exactly. Now it seems to be actual policy in many places.
Yeah.
We're seeing more trade deals settled directly in local currencies. China and Brazil, India and Russia skipping the dollar altogether sometimes.
Interesting. What about private money? Individual investors, big funds.
Similar story, actually. One source noted that in 2024, the main index tracking emerging market stocks, the MSCI Emerging Markets Index, actually did better than the U.S. S&P 500. First time in about a decade.
So investors are looking for growth elsewhere.
It seems so. They're seeking better returns, maybe, in places without the same level of central bank meddling or the kind of economic imbalances we see in some developed economies. Places with strong finances, resources, trade surpluses, think India, Indonesia, Vietnam, the UAE, they're becoming new financial hubs.
Okay, so if capital is flowing out of the U.S., or at least diversifying away, what does that mean for us, practically speaking?
Well, some pretty direct consequences outlined to the sources. Less demand for U.S. government debt means interest rates probably have to go up to attract buyers.
Which makes that huge debt burden even more expensive to service. Back to the first point.
Exactly, it's a feedback loop. Plus, if demand for dollars falls, the dollar itself could weaken,
And a weaker dollar means imports cost more.
fueling inflation right here at home. So foreign capital used to be a nice cushion for the U.S. economy. Now it could become more a constraint.
Could the Federal Reserve step in? Like, buy bonds to keep rates down?
They could, and the sources mentioned that possibility. But the risk there is pouring more fuel on the inflation fire, especially if you also have tariffs pushing prices up. It could create a kind of negative cycle for the U.S.
While other parts of the world, maybe Asia, decouple and keep growing.
That's a potential scenario discussed. You see big investment firms like PIMCO getting more cautious about the U.S. dollar and long-term treasuries, partly because of concerns about protectionism hurting the dollar's safe haven status.
And what about specific examples?
One source cites a Deutsche Bank report saying their Chinese clients are actively moving money out of U.S. treasuries into European debt, Japanese bonds, and gold. Why? Policy uncertainty in the U.S., maybe a better outlook elsewhere.
So it's not just economic, it's also psychological. The perception of the U.S. is changing.
That seems to be a big part of it. Political division, the fiscal mess, all the money printing. It erodes that image of the U.S. as the automatic safe place for money.
Investors are realizing maybe financial dominance doesn't last forever.
Right. Wealth tends to follow stability and sound management.
Right.
The sources draw a parallel to the shift from British to American financial power about a century ago. Maybe we're seeing the beginnings of another shift towards a more multipolar financial world.
A multipolar world.
Okay.
That leads perfectly into another trend the sources really emphasize, the comeback of tangible assets. That's the gold.
Absolutely. In a world awash with paper money created seemingly out of thin air by central banks, people are looking for things that are real, physical, things you can hold.
Like gold. And the price reflects that.
Definitely. Sources mentioned gold prices soaring past $3,200 an ounce in 2025. And it's not just the metal itself. Gold mining stocks, ETFs that are actually backed by Fiscal gold.
Those funds that let you invest in gold easily.
Exactly. Those and even broader investments linked to commodities are doing really well compared to traditional stocks and bonds lately.
And who's buying? We mentioned central banks earlier.
Big time. China, Turkey, India, loading up on gold reserves while trimming their U.S. Treasury holdings. That's a powerful signal about how they see the future of wealth and security.
What about regular people?
Them too. Increased demand for physical gold coins and bars, record amounts of money flowing into those gold-backed ETFs we mentioned, even big institutional investors who maybe used to ignore gold because it doesn't pay interest are now putting some money into it as a hedge.
A hedge against what? Inflation, uncertainty.
Both. And it's not just gold, is it? The sources stress this is broader.
Right. Things like farmland, energy stocks, timber.
Yeah, real commodities. Assets that have intrinsic value that can't just be printed into existence by a government or central bank. There seems to be this underlying philosophical shift happening, a return to valuing things you can actually touch and that have inherent worth.
Gold especially has that long history, doesn't it? As a store of value through thick and thin.
For millennia, it survived empires, wars, currency collapses. The sources even mention historical resets where gold played a key role, like Bretton Woods after World War II.
And there's talk now among the BRICS nations, maybe, about a new system potentially involving gold.
That discussion is definitely happening, according to these readings. The overall message seems pretty clear. Investors, policymakers, you ignore this shift back towards tangible value at your own peril.
Okay, so we have fiscal stress, Trade tensions, capital shifting, gold rising.
Hmm.
What's the bigger picture tying this together?
It seems to be this global move towards, well, national resilience, less reliance on sprawling, fragile global systems.
Driven by what? Recent events?
Absolutely. Think about the pandemic, the supply chain chaos it caused, the war in Ukraine, exposing energy dependencies, the U.S.-China trade friction. All these things have shown nations how vulnerable they are when they depend too much on others far away.
So countries are looking inward more, building up their own capabilities.
Exactly. We're seeing concrete examples everywhere. India offering big incentives for making electronics, chips, EV parts locally.
Southeast Asian nations building up regional supply chains, trading more with each other.
Yes. Latin American countries trying to use their resource wealth for more internal development. Even parts of Africa seeing a comeback in manufacturing, agriculture, local tech.
Is this just isolationism, though? Everyone putting up walls?
The sources argue it's more nuanced than that. They call it intelligent self-sufficiency. It's not about cutting yourself off completely.
It's more about
Producing more of what you need at home, strengthening ties with your neighbors, diversifying your reserves so you're not totally reliant on the dollar or any one currency. The goal is resilience, less vulnerability to shocks happening halfway across the world.
And technology helps with this.
For sure. Things like 3D printing allow for more localized manufacturing. Renewable energy reduces dependence on global fossil fuel markets. Digital payments, local data centers, they all help create more modular, agile economies.
So what does this mean for the U.S. if the world is becoming less globally integrated in some ways, more focused on regional blocks and self-sufficiency?
It means the U.S. can't just assume its old role. It can't count on being the world's main consumer, financing everything with borrowed money, or being the undisputed center of the financial system. In this emerging multipolar world, trust and influence have to be earned constantly. They're not automatic anymore.
Okay, so wrapping this all up, it really feels like we're at a pivotal moment, doesn't it?
It does. One source used the metaphor of a house of cards for the U.S. economy. Maybe looks okay from a distance, but built on shaky foundations imbalance, maybe some illusion, maybe some denial.
And the signs of that fragility are there if you look.
The sources certainly lay them out. Losing industrial capacity, relying on imports, a middle class squeezed by years of fiscal, well, let's call it delusion.
Asset bubbles blown up by easy money.
Eroding global confidence in the dollar, less reliable support from foreign buyers of our debt. It paints a concerning picture.
So the question isn't if things will change, but how. It feels like a choice is looming.
That's exactly how the sources frame it. A fundamental choice between continued decline, maybe slow or maybe fast, and a path of renewal.
And renewal sounds hard.
Very hard. The sources don't sugarcoat it. It takes political guts, economic humility, social resilience, a real shift from short-term fixes to long-term thinking.
Like what? Save more, produce more.
Basically, focus on real stability over temporary highs.
Now, the sources also mention America's history, right? We've faced big crises before and bounced back.
True. The resources are still here, the innovative spirit, that potential exists.
But this time feels different. Needs
Oh,
a
no,
more
no.
fundamental fix.
That's the argument, not just patching things up, but really rebuilding based on solid ground, actual productivity, sound money, a skilled workforce, strategic independence in a messy world.
So the two paths are pretty clear then. One is more inflation, bigger deficits, capital leaving, maybe becoming less relevant globally.
That's the potential downward spiral, the other path. Reindustrialize, get honest about the budget, return to valuing real things. But that requires sacrifice. No easy way out.
It's a stark choice. The sources even bring up fallen empires. Ottoman, Spanish, British, facing similar issues. Currency problems, overspending, complacency.
Yeah, historical echoes are there. But the key point is, decline isn't inevitable. It's a choice.
With courage, reform, humility, there's still a chance to turn things around. Not just be the world's biggest consumer or borrower, but a real producer again, a stable force.
That's the hope offered. But the illusion that we can just keep going like this, papering over the cracks, that seems to be fading fast. So the real decision is, do we keep patching, or do we start the hard work of serious reconstruction for a truly stable future?
That definitely gives us all something to think about.
It absolutely does.
Well, thank you for taking this deep dive with us today. It's obviously complex, but so incredibly important. We hope digging into these sources brought some clarity, maybe a few of those aha moments about the huge economic shifts happening right now.
Hopefully so.
And we want to leave you with a question to mull over. When you think about all these trends, the debt, the trade shifts, the capital flows, the return to tangible assets, this move towards national resilience, what does that mean for your own financial future? And looking at the bigger picture, what do you think are the most critical steps the U.S. needs to take right now?
Lots to consider.
Indeed. We hope this conversation empowers you to think critically as the global economic story continues to unfold. Thanks for listening.